The US government and the Federal Reserve have claimed victory on inflation. Inflation is over and the inflation battle has been won without any recession and without any challenges for the economy. It is an absolute victory. Everything is going phenomenally, except it's not true. Number one. Consumer confidence in the United States. Consumer confidence in the United States is plummeting. The current conditions index is not just exceedingly weak, and this is allegedly in a robust economy, but it's just close to the 2022 lows and massively below the 2020 levels. We're talking about an absolute disaster in terms of consumer confidence. Consumer confidence is an indicator of what the reality of the economy is beyond GDP and beyond unemployment figures that are bloated by government spending, by debt, and by government jobs. Let's go to the next graph, which also tells us a little bit more about this lack of victory on inflation. This is producer prices, no? Surprise. Oh, this is what you read everywhere. Surprisingly hotter producer price index. Well, not surprisingly. What we have seen is that money supply continues to grow. What we have seen is that government spending continues to imply more money printing. We continue to see very elevated deficits, and the overheating of the economy via government spending is leading to more aggressive levels of producer prices than what were initially expected. Think about this. Let's go to, if you go to the last column, what you can see is that since April, there's basically been no disinflation process. 3.2% in the previous 12 months is a constant inflationary process in the less volatile part of producer prices, the one that excludes energy and trade. 3.2% in an environment in which this part should be significantly below 2%, and is actually higher than it was in 2023 and in the first months of 2024 on an annualized basis. If we go to the first column, what we can see is that the process of disinflation is inexistent. You have a month in which it is 0.2, a month in which is minus 0.2, but what you basically see in 2024 is 0.4, 0.6 increase, 0% increase, 0.5 increase, 0% increase, 0.3%, 0% increase. What we're talking about is a constant erosion of the purchasing power of the currency in producer prices. This is what it's signaling, and it's certainly not a victory on inflation. Let's go to the next graph, which also shows us in CPI what is really going on. In the last 12 months, the consumer price index has shown a reduction that has come mostly only from energy. Energy prices, oil prices were declining. We were seeing that natural gas, gasoline, etc., all these prices were actually falling, and falling quite significantly. Think about it, minus 6.8, minus 15.3, minus 20%. Not small declines, huge declines. But what was happening in the rest of the items? Look at the yellow part. In services, 4.7% annualized inflation. In shelter, 4.9% annualized inflation. In transportation services, 8.5% annualized inflation. Look at it month on month. If you look at it, more than 60% of the items in September, in August, were actually rising versus the ones that were declining. And if we look at the annualized level, this level of inflation should actually be today well below 2% and well below 2% certainly in core inflation if the policy of central banks was actually tightening, which is not in any shape or form. Let's go to the next graph, which shows us a little bit more what is going on. The bond market doesn't trust the Fed, doesn't believe the Fed. The Fed is talking about rate cuts and about robust economy and disinflation. The bond market says, no way. look at it. If you look at the performance of bond yields, it is very evident that since the Fed entered into panic mode, which was in June, the Fed started reducing the pace of normalization of the balance sheet. And yes, that led immediately to a reduction in bond yields, obviously, because it was more money supply, more printing going into the financial market. Absolutely. Reducing the pace of normalization is actually printing. Let's go, and what we can see is that in September, the Fed panicked for the second time, and that was when it cut rates by 50 basis points in an allegedly robust economy with disinflation and with a soft landing and zero, in fact, according to Mr. Powell, risk of downturn or recession. So what is the bond market telling us since then? Rate cuts, increase in real rates. What we can see is that the 30-year bond yield is actually at the highest level seen since July, that the 10-year bond yield is actually at the highest level also seen since May, and that the curve is actually rising in terms of bond yields because the market is either discounting higher inflation or a much weaker economy, and certainly a much weaker solvency of a US government that pays no attention to inflation or to the economic and fiscal implication of its irresponsible policy. Let's go to the next graph. The next graph shows us exactly what is happening. No, my friends, it is not about oil prices and geopolitical risk. It is about monetary debasement. And what you can see here in white is gold. Gold is rising, which is discounting that monetary destruction. And at the same time, since rate cuts started, copper, food prices, and oil have all started to rise. Oil, is true, has bounced back. It has made a U-turn and round trip from the decline seen previously when rates were slightly elevated. But obviously, oil prices have a floor created by geopolitical risk and are rising due to the monetary phenomenon, more money going into relatively scarce assets. But the rise in food prices, in aluminum, in copper, since the rate cuts is actually higher than that of oil. And that's what we need to understand. It is not about geopolitical risk. It is not about oil prices alone. It is about monetary debasement. What we are seeing is the destruction of the US dollar in real time. Let's go to the next graph. If we go to the next graph, what we can see is how to protect yourself. Yes, they're going to engineer what they call a soft landing. How? More government spending and more debt basically maintain GDP bloated. Yes, and also government jobs. But what we need to understand is that in order to protect ourselves against a destruction of the monetary of the currency purchasing power environment, what we need to do is invest. This is according to Apollo, the performance of the S&P 500 in periods of soft landing with rate cuts. 25%, with an increase mostly coming from those sectors that benefit the most from monetary destruction. So we need to pay attention to this, because the best way to protect yourself against monetary debasement is investing in the United States stocks, and certainly in those that are more benefited by monetary debasement, as well as gold and obviously some cryptocurrencies, Bitcoin in itself, considering the volatility. Never forget the volatility. Let's go to the next graph. If we go to the next graph, what we see, courtesy of Hedgeye, is exactly what I've been mentioning. Money supply has been not accelerating, but accelerating at the fastest pace seen since 2015. It's happening so fast that most of the increase in global money supply has happened in the period between August and October. Very, very dangerous to ignore monetary factors when we think about inflation and when we think about growth and investing. This is the most important factor, and why we need to pay attention to it is because it can lead to a very different performance of the different asset classes. We need to protect ourselves investing. Hard assets, gold, cryptocurrencies, no, Bitcoin, and also on stocks. All of those may help you avoid the erosion of the purchasing power of the currency. Let's go to the next graph, which goes on talking a little bit about what is happening in China. In China, everybody's talking about the slowdown and everybody's talking about the stimulus package. But the stimulus package cannot be driven by more government spending. It's a negative message. Why? Because if anything, China's challenges come precisely from excessive government spending. So the fact that local fiscal spending is below budget is actually a positive, not a negative, which is what neo-Keynesians try to tell us. And this is something to pay attention to, because it also means that China may grow, but not as fast as others are expecting. That is not a bad thing. That is actually more prudent and more efficient and certainly healthier way of growing. Let's go to the final graph, which tells us what is really happening in China GDP activity, courtesy of Bloomberg. GDP activity, real GDP, fixed asset investment, and industrial production, as well as retail sales year on year, growing at a certainly robust level, 3 to 7%. It's not a bad thing. Certainly way below the 20 to 21 levels, obviously. But what I think is that this is showing is that China knows that more government spending and more debt is likely to generate more problems than benefits, and that the challenges of the Chinese economy come precisely from excessive stimulus packages in the past. So this is actually a much more healthy and much more robust way of growing than the one seen in the recent past, and the way to absorb the imbalances created by previous excessive government spending packages. Keep defending freedom. Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.